If you're looking to access capital, you've got to watch this video. A lot of businesses these days are looking for additional capital so they can invest in a startup or invest in a secondary business in a different industry so that the income from that secondary investment will subsidize their current income for their lifestyle, their business, because of the impact they've had out of COVID. A lot of other businesses are simply looking to take advantage of the current economic times and access capital to expand their existing business or even to acquire businesses in other countries. In this video, I'm going to share with you the major differences in working with a bank versus a venture capital firm versus a private equity firm, and when you should be using either one or all three of them. My name is Taimour Zaman. You've got to watch this. Hi, I'm Taimour from LineofCredit.ai. My organization is a world-class leader in providing lines of credit. We also help companies enable, issue, as well as monetize various banking instruments like standby letters of credit, documented letters of credit, MTNs, bank guarantees, and so on. And the third thing we do is help companies participate in safe, private placement programs that work and pay off. In this video, I want to start to talk about the differences between working with different banks, venture capital firms, private equity firms like that. Oftentimes, businesses want access to capital, but understanding the business model behind different institutions is really important, so you can partner with somebody whose objective, their business objective, lines up to your needs. That's really critical to understand that. With that in mind, I want to share a simple and a really fact opinion on the importance of the ability to access capital regularly and consistently. I want you to imagine you and I run a business. You run a separate competing business to I. Imagine you are importing, exporting coffee, and I too am importing, exporting coffee. I want you to imagine both you and I are using the same coffee grower, we're using the same coffee processor, and so our coffee beans is identically the same. The one way that I can exponentially outperform you, outnumber you, beat you, however you want to language it for yourself, is my ability to access capital consistently and reliably. If I can access capital far better than you can, and if I can do it consistently and reliably, I will use that capital to make a secondary investment and have a better lifestyle, because now I have profits coming in from two different industries. If I can access capital and you can't, I can make that investment, use that capital to make investment in technology, outperform you. I can hire better thinking talents, smart consultants that you can't, I can outperform you. So if everything stayed the same, but I have the ability to access capital and you can't, can you see, or could you consider that I can exponentially outperform you? Fact is, businesses today must be able to access capital consistently and reliably and invest that capital so that it can exponentially outperform their competitors as well as achieve their goals and objectives. But yet there's some major differences when it comes to working with banks versus venture capital firms versus private equity firms. So I'm going to tell you a story that I think most people understand. And I want to share the story of a guy called John Smith. John Smith is a fictional story, but it talks about a lot of case studies that we are seeing within line of credit that I think would help you see something that you haven't been able to perhaps see until now. John runs a very successful business. It's a manufacturing business, and after COVID, he needs access to $15 million. And he wants to put that $15 million, part of it, to acquire a supplier out of Mexico. Acquiring this supplier out of Mexico will give him a competitive advantage. But then he also wants part of that money to expand his existing business and put a chunk of it on the side because he needs it for operational expenses. So out of $15 million, let's say he needs $3 million for the expansion of his own business. Another $7 million to acquire a supplier out of Mexico, and $5 million to put on the side. That's what John Smith needs to grow his business for what he needs to do really quickly. So John goes one day to the bank and says, Mr. Banker, I've been a client of yours for 20, 30, 40 years. We're a good client. I'm looking for a business loan. I want to expand my business. I I'm going to buy a business in a different geography called Mexico. Can you please give me a loan for $15 million? 10 to 15 is what I really need. The bank will look at the file and say, okay, let me give you a term sheet. Generally speaking, the bank will come and say, well, we always want clients to put a 20% down deposit. It's like buying a house. You want to buy a house, you need to have 20% down, and the rest of the bank will finance. Okay? You need to have collateral, so in case you don't pay us back, we want to go and take over that house or take over that plant or take whatever it is, because we need to make sure our capital that we're loaning to you is fully secure. And by the way, John, you better have a good credit rating once we do a credit check on you. By the way, that business in Mexico, well, technically that's a different legal jurisdiction, and if I give you the money for you to put it $7 million of what you're looking for in a jurisdiction outside of my control, if you can't pay that back, I'm in a bad shape. I can't collect. So I don't know if I can do that. But the $3 million you're looking for, I'll give you 80% of that today. And so 80% of $3 million becomes $2.4 million. So what John is left with is he still needs over $12 million for him to expand his business the way he wants it. So John thanks the banker for their time and attention. It took them, like a couple of weeks to meet the banker and get a term sheet and all that stuff, and then comes to the conclusion, well, the bank doesn't solve all his problems. And if anything, they're making a small dent into what he's looking for. So John picks up the phone, starts calling his network, goes on LinkedIn, websites, whatever he needs to do, talks to lots of joker brokers out there, and eventually meets a venture capital firm. Goes to Mr. VC and says, boy, I'm in a great business. My business is exploding, and I need access to $15 million so I can, jump on this curve and really take advantage of it. The venture capital firm looks at the business and says, this looks like a good deal. I think we can do the transaction. Let's go. They provide an offer and they'll say, we'll give you the $15 million. However, with us putting $15 million, we want to be a 50% equity partner. We need to have a board seat so that you don't make bad decisions or you don't make decisions that would impact our investment in you. We will make that investment, give you the cash you need to do the deal in Mexico, because your bank doesn't do that. We understand you need $5 million for operating just to put that in your bank, so we'll do that. But we have control or some kind of control over your business. So what that means for John is that every time he needs to make a decision, he now has a friend that he has to talk to. And he better hope, wish, and pray that a friend is aligned to his business views and vision. And God forbid if another version of COVID hits, that partner across the table better be aligned with whatever John wants to decide to do. And that's the decision John needs to make. So then John says, okay, that's awesome. Let me see what other options are there. Goes out to look for venture capital firms. Okay, I've talked to a few. Now let me talk to a private equity firm like LineofCredit.ai. What can LineofCredit.ai do? Well, a private equity firm like ours usually gets clients' businesses or gets them the capital they need in various ways. Sometimes a private equity firm like ours will put up the money and help support the client. Sometimes we will leverage the client's asset to get them the capital they need, but specifically in terms and conditions that works for that business so that entrepreneur can continue creating meaningful change in the world that they want to do, that they're interested in doing. So let's talk about LineofCredit.ai and some of the programs we offer. So one of our programs is called Rent a Rich Uncle program. In this program, we put up our money. We're not sending the client's file to 10,000 joker brokers or lenders. We put up our money with the client's bank, and we're putting up $20 million or $17 million, but with two conditions. Condition one, for the bank to lend the client the $15 million they're looking for. That's really important. The underwriter is the bank, not us. And now that gives John not a business partner, because we're not becoming business partners with him. We're not taking equity on him necessarily. We're simply giving the funding he requires for him to do whatever he needs to do. Now, our capital cannot be collateralized. An institution we put the money on can be a willy-nilly institution, has to be a FDIC insured institution, but we're putting up our real money so that John gets to have whatever he needs for his business expansion. Another offer, another opportunity for a company like ours is that we can help him access the capital he needs. Even if he has bad credit, even if he doesn't have the resume to do the things he wants to do, simply by leveraging his existing cash, his existing assets in his business, and to leverage that, put that into some kind of instrument, create the line of credit loan that he's looking for to help him do that. The final thing, or another thing a private equity firm can do that banks can't do or venture capital firms can't do, is to create a vehicle. If John has investors, we can have those investors deposit their money in a standby letter of credit. Leverage that standby letter of credit, monetize it while the investor's instrument or money is completely safe in their bank account. We can leverage the standby letter of credit, get a loan against it, or simply sell it at a discount and give John the capital he needs, the $50 million he needs for him to grow his business. These are some very creative, I don't want to say creative, they're very standard for us, but there are lots of people in the world that just simply didn't know that they can leverage or different programs of utilizing assets to create the cash or the line of credit business needs for them to grow. There's a fee structure to private equity firms that's different compared to what I call joker brokers or other structures. Private equity firms, generally speaking, are not looking for equity. Sometimes, depending on the structure of the business, there could be an equity play for sure. But a private equity firm like ours is just like a law firm or accounting firm. Every time you start to engage them, you're paying for the service. You're paying for the years of experience private equity firm has. If the private equity firm is putting up its capital or doing something like that, now there's a, they're also getting a percentage of the amount of capital they're putting up. Every project is different, but private equity firms simply are not, generally speaking, working on commission-based something so that at the end of it, they're praying that they get money. It doesn't work that way. It's more like a law firm or professional services firm where it's an engagement kind of a fee agreement. We have some free money programs where we can leverage a client's assets, turn that asset, the leverage amount, into a loan, leverage the loan in an investment instrument, and give clients the capital that they're looking for. So let me give you an example. Let's say John Smith has a Picasso he got inherited to him from his father-in-law, as an example, and the Picasso is worth $6 million. A private equity firm like ours will assist John in getting a lender that will loan, let's say, 50% on the Picasso. The lender takes possession of the asset or gets a safekeeping receipt or something like that, but lends cash on it. We would then utilize the cash and put it in an investment instrument like a private placement program or a hybrid program, and turn that cash into an investment instrument that would turn, maybe pay up $20 million a month. Leverage that $20 million to first pay off the lender out who took collateral over the Picasso, and then make sure that John is getting so-called free cash every month out of that $20 million that comes in for, let's say, 10 months kind of thing. Those are the big differences between a private equity firm, things that a private equity firm can do that banks or venture capital firms can't do. Now I want to tell you when I would go and use either one of these services, simply because A, I've run a venture capital firm, I've borrowed money from banks, and today I run a private equity firm. So I'm going to tell you when I would choose either one of them for myself. If I was looking for a loan, assuming I had good credit and the loan wasn't like some large number of $1 trillion, and my bank could fund it fairly cheaply, I would go and get a loan or line of credit from my bank all day long. Even if I don't need the loan or line of credit, I would still go and apply and get the line of credit loan out and invest that money that I don't need in a safe investment like a real estate or something like that, and use the profits from that to pay down the loan, but also to create a second income for myself and my family. That's when I would be using a bank all day long. The time when I would go to a venture capital firm, remember, I'm sharing equity with somebody, I'm getting in bed with somebody who I don't know. I would only do that when the person who's a venture capital firm has done not one, but multiple exits in the industry that I'm in. So if I was going to sell Facebook advertising, I'm just using that as a very bad example. Let's say I run a Facebook advertising agency, and I'm looking for VC funding. I would go and look for a VC who's run online ads, social media ads, and has done not one exit, but multiple exits. Because that person who I'm getting in bed with has something to teach me. Their vote could actually be a smart vote, for sure. And that's the time, any day, hands down, I would go to a VC who's done not one exit, multiple exits. It has to be more than one, because the first one could be a fluke, the first one could be accidental, the first one could be various ways why the guy did an exit that I may or may not know. But I want to know multiple exits that they've done. And you'll be surprised how many entrepreneurs are out there who've done 6, 7, 8, 18, 20 different exits all day long, specifically in one category. That guy or that girl is worth having as a VC partner, especially if they're putting up their money. For all those other circumstances, when I will go to a private equity firm, if a private equity firm is willing to put up their money at my bank so I can get a line of credit, I'll go to a private equity firm all day long. If a private equity firm has the capability to leverage some of my monetizable assets and put that in something like a safe private placement program, and now I'm sharing the profits on that, hell, I would do that all day long. And so that's when Taimour, will go to any one of these three utilities and leverage them for my benefit. I'm going to talk a little bit about linofcredit.ai and what people are saying about us. If you talk to some of the broker dealers we work with, like Jeff Robinson, you'll see some kind words about our experiences and ability to help him and his clients on some of their transactions. If you talk to Michael as an example, he's a 2 times former banker, investment banker. He will tell you about our creative abilities to come up with creative structures and therefore create profits that a bank or venture capital wouldn't be able to do. If you talk to William as an example, he'll tell you that we are excellent coming up with creative financing structures. That's it for me at linofcredit.ai. We are a private equity firm. Our goal is very simple: providing clients with lines of credit, loans, and amounts that banks or brokers simply can't provide. I look forward to the opportunity of working with you and your team. Thank you so much.